Recipes for technical trading success in Cook's Kitchen.
Who's afraid of the China stock market bubble? Not me, and I'm going to tell you why today. You know, when I was making my slides to do this video this morning, I was doing a bunch of stuff on market breadth. I was going to look at moving averages, new highs, new lows, the advanced decline, all that stuff, and I thought, you know what, this is really boring. Let's do something fun. So that's what we're going to do. All right. This is a graph that I love. I've been showing it to market timers for a couple years now. It's about the rise of the middle class globally. Now, and I found this graph after I sort of summarized my view that there are at least 2 billion people globally aspiring to the middle class, the lifestyles of, developed nations. They want better jobs, better food, clothing, housing, transportation, hospitals, factories, roads, you name it. And, so you're talking about China and India primarily, Brazil too, Russia. These nations they see their governments trying to find ways to provide for people and create those lifestyles of the advanced countries. Which are visible to everyone now on the internet. And so that's where the aspiration comes. People know there are better jobs and better lifestyles out there. So let's go back to this graph, this excellent graph. This is from Artisan Partners. They're a money manager up in Milwaukee. They manage about $110 billion, and they like to focus on emerging markets. So what you're seeing here, this is they're using OECD data. And so in 2009, spending from the so-called middle class was about 21 trillion, and that's 1.8 billion people. And they define the middle class as households with daily per capita incomes between $10 and $100 US in purchasing parity terms. So you have to account for currency there. So, what are they looking at? This 21 trillion in spending in 20 years could climb to 56 trillion. That's a 150% rise. 56 trillion annually, with the middle class rising to a population of nearly 5 billion at that income level. So that's a tremendous rise in middle class numbers and correspondingly middle class spending. Now, this is a reason to be bullish on emerging markets. It's also a reason to be bullish on the U.S. equities and the bull market. While our GDP shrinks, as our growth rate slows, and hey, we may never see 6% GDP in the U.S. again, the rest of the world is growing rapidly. Yeah, it's volatile, but, remember, so our GDP may be small, but what are our corporations doing? 45% of U.S. corporate profits come from abroad. That's why Apple is killing it in China right now. They will continue to do so. And they've got, $150 billion in cash overseas. This is a trend that is going to keep going. And that's why you want to be an investor in emerging markets. And I think the bull market for the U.S. continues because of the force of trends like this. And, this is a graph you want to take the video, stop and pause it, and take a close look at it to understand it better. But right now we're going to move on and drill into more specific numbers about China. Let's find my tools here. Okay, so what do we know about China? We know that it's been an investment-led growth economy, right? They're piling money into infrastructure, and they've been a net exporter for years. What has that done? That's created a tremendous wealth for them, being huge net exporters. And so now they're seeing, their economists have looked at the big picture here and the rise of economies in the past 100 years, and they see, hey, we want to be more like the West. Now we need to develop our consumer base, and that's what they're trying to do. So this is an excellent graph. This is from the Demand Institute, which is a think tank led by the Conference Board, I believe, and Nielsen. So a couple of real statistical research houses there created this think tank called the Demand Institute. And they're also taking a look at these long-term trends. So what you're seeing here is, let's go back to, on the bottom here, 1999, China's GDP was 4.2 trillion, okay? And consumption was almost half of that. But as China, developed more, buying raw materials, building bridges to nowhere, as they say, and cities, empty cities, what you end up with in 2011 is a nearly $11 trillion economy where consumption is only 28% of the pie. Okay, so where are we now? Fast forward to 2015, China's economy is overtaking the U.S.'s in terms of GDP, over $17.5 trillion. And in the first half of 2015, consumption was 60%. So the shift is happening big time. In the U.S., we throw around the number, say 70% of the U.S. economy is consumer-driven. Well, China almost got there this year. Now, that is probably, there's going to be some ebb and flow there, and we're going to take a closer look with some numbers from the Demand Institute about what they're projecting. All right, I think I covered everything here. This is another good one to take a look at to see the trends. All right. So where I got this data from the Demand Institute based off this Bloomberg article from last week about the 67 trillion consumer economy that's coming. So Enda Curran wrote this article last week. I want to give full credit here, and this is where I've gotten the charts and pulled some of the quotes. So let's talk about China's $50 trillion consumer. Now, the Demand Institute, the study is by Louise Kelly and Brian Anderson. They say that there are signs that the decline in consumption's share of GDP may have abated, but it has certainly not yet been reversed. So again, what they're saying is, let's not get too excited. So we had this this surge to 60% of GDP was consumer-driven in China, but they don't think that that is the new trend. They just think it's slowly turning around. But let's take a closer look at their numbers. So in their analysis, they paint out two scenarios, both based on China's GDP growth slowing from 7% down to 4%. So, and that's by 2019. And they think it could stay that low. So that right there is pretty dramatic. I don't agree that China's GDP, that they're going to let it go below 5 or 6%. But apparently they think it's a given, because in even their most optimistic scenario, the Demand Institute is looking at a slowing of Chinese growth to 4%. Okay, but let's say that's true. The GDP is still growing, right? And the consumer is becoming a larger part of that pie. So still growth. Okay. Now, so under their first scenario, which they think is most likely, they see the consumption share of GDP would remain constant at about 28%. So they're not looking for this, 60% number that we had in the first half here, for the next 10 years, with total spending reaching about, in a dollar equivalent, of about $53 trillion. Okay, so there's your $50 trillion Chinese consumer rising in the next 10 years. And that actually, that first graph I showed you from Artisan Partners and the OECD data, that it blows away some of those numbers. It's moving much faster, the growth of the middle class and consumption. All right. So in their second scenario, what if consumption rises even more? So they say, okay, what if they get back up to 46% of output is from consumption in the next 10 years? That would equate to annual spending rising 126%, and consumption would balloon to 67 trillion. So that's where the 67 trillion number comes in that you're going to hear tossed around, annual Chinese consumption. And then they go on, they say, okay, this, they give the basis for this data. They didn't just make this stuff up. They did a study of 167 countries from 1950 to 2011, comparing similar fundamentals to China and looking at consumption remaining flat relative to GDP for some time after it stopped falling. So to them, this is a very slow ship that turns around. Consumption as a percentage of GDP in China fell quite a bit, as investment led, they see it stabilizing and being flat for a long time. But even in that scenario, that sort of pessimistic scenario, they still see the Chinese consumer representing 53 trillion annually by 2025. Those are some big numbers. And that's why you want to look for opportunities to invest in China or have exposure to China through U.S. companies like Apple. All right. So let's take a look at the Chinese stock market. This is a 5-year chart. It's a weekly chart, and I've got 20 and 50 period moving averages on here. So you can see how subdued the market was for the longest time. I mean, they were in a bear market. While our market was surging, Chinese stocks were still in a bear market. And then obviously this liftoff here, what happened? Well, last summer they instituted plans to link the Hong Kong market with Shanghai, so now more money from outside could come into China directly into their share markets in Shanghai and Shenzhen. And once that link got rolling late last year, the market started to surge in the fourth quarter. And I was watching this, and I expected it to happen, but it sort of got away from me. And like once the Shanghai Composite was above 3,000, I was like, okay, where is it safe to get in? And if you blinked in the first quarter of 2015, then it just vaulted. And so this is the speculative bubble here, where it's 80% driven by Chinese retail speculators on margin, and then the bubble burst. But I actually think that this 3,000 level in the Shanghai Composite will hold, and I would look to be a buyer there. Thinking that, hey, it's not going to enter a permanent bear market. They're just wringing out the excesses, the excess margin, leverage, and the massive speculation. Obviously, the Chinese government is doing all they can to hold things up, and for good reason. We saw that report last week that got leaked from Bridgewater, the largest hedge fund in the world, Ray Dalio, saying that this bubble burst in China will actually impact GDP. And he said by as much as 2.5 percentage points. So that's why they became very bearish on China for that reason. I'm not so sure. We'll see how it plays out. I think that there are stronger forces in play, and you have to remember the Chinese government has been looking at this problem for a long time. They're prepared to backstop the markets and taking those measures, and they've got the wealth to do it. They've got the foreign exchange reserves. All right, so that's the Shanghai Composite. How do you invest? How do you trade it? Well, here's one way. Here's the popular ETF, the A-shares ETF from Deutsche Bank, and so I'm showing a 2-year chart here, a daily chart. So they're not exactly comparable. So here's the fourth quarter of 2014 surge initially, and then the first quarter surge, and we're settling back in here. So what would correspond to that 3,000 level in the Shanghai Composite? Just between 33 and 35 on the A shares, and that's where we look to be a buyer again. Some people are saying that the Shanghai Composite is going to go all the way back to where it was last summer and give up 100% of the gains and go back to 2,500. I don't see it, but if you want to play it with A shares, I think your risk is low, and that's one way to do it. All right, I hope you enjoyed this look at China's economy and what we can expect for the next 5 to 10 years in terms of huge middle-class growth and spending. These numbers are hard to wrap your head around because they're so huge, but to me, they argue for remaining a bull on equity markets in the U.S. and abroad. All right, I'm Kevin Cook. Thanks for joining me in the kitchen.